Hello, I am Mijun from the American Stock Exchange University. Let's start today's United States stock news on April 8th. We welcome you to Mijun, who is consistently maintaining the essence of United States stock investment, even today. Yesterday, I was so busy recording the broadcast that I couldn't mention Mija, but honestly, I was a bit surprised when I saw the comment section of Mijun yesterday. Why? Because last Thursday and Friday, the United States stock market plummeted nearly 10% in 2 days. So we've had a historically rare market situation that's only happened 4 times. So to be honest, I was quite worried on Monday. I thought there would be a lot of people feeling a bit down in the comment section on Monday, and the atmosphere would become quite grim, but surprisingly, it was very positive and hopeful. So personally, I was a bit surprised. I never imagined that the comment section would be this lively. If I show you a few comments for a moment, here, Mr. Moonha left this comment under the moonlight, Mr. Mine. I will also appreciate today's broadcast. During the corona outbreak and during the gold price crisis, I remember the day when I endured this hardship while watching Mr. Mijihun's broadcast, and I hope that our Mijihun family will endure well this time as well. He shared positive energy. What I felt while reading this article, Mijihun's broadcast has been running for 5 years now, so the dedication of those who have been with us has also accumulated a lot during that time. As we get used to the hard-to-reach places we often visit, we now have a good impression of the many investors who can endure even in such a harsh environment. To all those who joined this broadcast, if you have sadly overcome this downturn, I take your wishes. Well then, let's start today's midday news that we sent on April 8th. Today as well, we will try to organize from yesterday's Midday Hope. Yesterday, the American panel members might not have felt it was such a good situation. Why? Because overall, there were more red stocks, and despite the market being down, you could see red here and there, and most of the red was artificial intelligence performance. Whether it's Nvidia, Broadcom, Palantir, Amazon, or Meta, only stocks representing artificial intelligence have risen, so there was a negative impact on the American portfolio. You should see it this way. However, overall, there were significantly more falling stocks. The trend of the market's breadth narrowing further is not good, and this trend continued yesterday as well. In fact, if you look at the breadth of the S&P 500 market, the line has fallen to here, which means it has fallen to 6.95. Less than 7% of the 500 stocks in the S&P 500 index are currently in an upward trend. If that happens, if you look to the side, there hasn't been a single time in the past year where the market has narrowed down this much. Then let's change the period a bit. Even if we change it to 2 years, it's the same. The narrowest point here was 8.6, as you can see. Therefore, during the past 2 years, there was not a single time when the market fell below 7 like this. Well then, let's extend the period to 5 years. Now, if you look at the situation over 5 years, there was a time when it fell below this. When was it? It was September 23rd, 2022, when the market fell below 5. Well, but you all will remember, if it's September 2022, it's the bottom of the bear market. So at this time, seeing the market's breadth shrink so drastically, it was a time to buy stocks instead of being scared, if you see it this way. At that time, we hit the bottom twice. There was one more here. The breadth of the market fell to as much as 1.98, and then it fell again to below 5 as the market was preparing to end the bear market, if you see it this way. Shall we extend the period a little more? If you look at it in 10 years, there was one more situation where it stopped here. It fell to 1.19, and this was on March 20th, 2020, which was the bottom of the corona. The fact that the market's breadth is narrowing to the extreme can be interpreted as a negative signal that the market is touching the bottom. Next is the distribution coefficient. The volatility index has fallen slightly from yesterday, but it is still unstable and has risen above 40 so far. It's currently at 43. This current chart is from 2015 to 2025, so it's a 10-year chart. The only time it has risen to this level in the past 10 years is here, that is, excluding the 2020 corona crisis. The distribution rate has never fallen this dramatically. Therefore, the fear index is not the time to leave the stock market now, but the bottom has come, so hold on a little longer. It is conveying such a positive message to us. Next is the fear exploration index. The fear exploration index has now fallen to 3. In my memory, it seems like a long time since it fell to 3. Therefore, in the market, the fear exploration index is also throwing a signal to us that the bottom is here, recording a low number without any precedent. This can be interpreted historically. Well, it's been a long time since the market score of the cheesesteak. The market score has fallen to as much as 26. I think it's almost the first time I've seen the market score of the cheesesteak fall to 26. And to interpret what the number 26 means, you can click here on the market score, then the screen moves and the interpretation comes out. It's a state where anxiety is spreading in the market. Therefore, the strategy of focusing on the type of wealth and selectively buying is effective. Even from the cheese stack, it's throwing the same message. We were able to reconfirm through various indicators that now is the time to buy stocks because of the overwhelming sense of insecurity. I'll analyze the performance of the top United States stock market pick. Yesterday, the United States stock market's top pick, Credit Technology, rose 7.84%, leading the market. The second best was Celestica, plus 6.41, followed by Inodata, plus 6.21, Broadcom, plus 5.37, Palantir, plus 5.17, Talon Energy, plus 4.97, Vistra, plus 4.71, Nvidia, plus 3.53, Amazon, plus 2.49, Meta, plus 2.28, and Uber, plus 1.58. Alphabet rose 0.79% and Bitcoin surged. It's at 79,170, and the rest of the stocks went down. DSMC fell 0.43%. 2.56 the Nasdaq and 2.87 the Street G fell by 8.67, and finally B2 fell by 14.31%, which was the worst. I would like to show you two charts first in today's broadcast. I would like to briefly introduce this article to you all because something very interesting happened. It's a very short article that I shared with our members on Sunday, April 6th. The S&P 500 index's main benchmark is the 4,850 level. If you look here, after the rapid rise following coronavirus disease 2019, the market's point in 2021 was 4,850. Well, if you look here, this was the bottom of corona. And the stock price continued to rise, hitting a peak and then falling into a bear market. At this time, the peak was 4,850. And now in 2025, the stock price is plummeting and is going back to its previous high point. We can examine these facts through technical analysis. The resistance point typically acts as a strong support line. So if we look at this chart now, perhaps it could fall to 4,850 and then rebound. This is where we can hold out hope. Well, something very interesting happened yesterday. Yesterday, the stock price closed at 5,062, but in fact, it plummeted drastically in the early stages. If you look here, it fell to 4,853 around 10 in the morning, right? 4,850, this is the level that plays the role of support line. So yesterday's stock price fell to here and finally showed a rebound from the support line. We can interpret it technically like this. Well, anyway. 4,850 is also an important benchmark as it is the point where the market's 5-year upward trend line works. Such a message is being thrown. Well, what does this mean? There are 2 points here. The first point is the 2020 corona low, and the second point is the 2022 bear market low. And if we continue to rise from these two bear market lows, this is where 4,850 is formed again. So we can check this part, which was a very important technical point, the 4,850 that matched with the 2021 high we mentioned earlier. Therefore, the fact that the United States stock market hit the low point of 4,850's resistance and showed an upward trend yesterday has a very important meaning. Again, it's not a medium-term perspective, but could yesterday have been the bottom in the short term? We will carry this kind of hope. The next article prepared is a forecast about the United States stock market. The United States stock market outlook we're going to look at today is being discussed by Canapesier. Personally, I really like the investor Canapesier. I've read about 100 books that he has written, and I'm not sure if you all know why Canapesier became famous. He became famous as the first investor to use something called price-to-sales ratio, which stands for price-to-sales ratio. Just to give a brief introduction about it, in the past, the number of people who invested in growth stocks was extremely small. In cases like Warren Buffett, they practically never even look at companies that can't generate net income. But the thing is, the advent of companies like Campfire has become a turning point for growth stock investors, and among growth stocks, there are those that are overvalued with extremely low market dominance, which should not be invested in, and there are also genuine growth stocks. It's extremely hard to differentiate between these two company types, as most growth stocks have little to no net income. Therefore, if you use the price-earnings ratio, it becomes difficult to distinguish between genuine growth stocks and overvalued growth stocks. So what about the competition? Then, wouldn't it be possible to compare sales? So what about the price-to-sales ratio? How many times has the current market capitalization increased compared to the sales that the company has made in a year? Therefore, if the price-to-sales ratio is extremely low, this company can either turn from red to black, or if the margin starts to increase, there is a high possibility that the stock price will skyrocket while receiving a very reasonable valuation. This is something we can look forward to. Let me show you what the current average price-to-sales ratio of the target is. Yes, it's shown here. Among the average topics, the type with the lowest price-to-sales ratio is Celrestica. In the case of Celrestica, the price-to-sales ratio is 0.81. What does that mean? It means that the revenue generated in 1 year is more than the current market capitalization. Therefore, if Celrestica's margin improves, it shows that the price-to-sales ratio can be much lower than the current price-earnings ratio. The price-earnings ratio is currently 13.7 times, but this 13.7 times can actually improve. This allows us to confirm that the market capitalization is extremely low compared to the revenue. The second cheap category is Vistra Energy VST, which is 1.96. So if you add 2 to the revenue made in a year, you get the market capitalization. So if the margin increases, it's incredibly cheap. You can see it this way. The third is Nextracker. Nextracker is 2.00. So if you add 2 to the revenue, you get the market capitalization. Yes, the third is Amazon. In the case of Amazon, the price-to-sales ratio has dropped to 2.81. The fourth is Uber. Uber is 3.08, 4.56. Google is 5.12, and beyond that, 5.13. Meta boasts a relatively cheap pounds per square inch of 7.77. Well, and if you look, Tesla is also not bad at 7.84. So, if Tesla's margin improves, at the current price-earnings ratio level, it's an extremely expensive stock, as shown here with a forward price-earnings ratio over 92 times. However, if Tesla's margin improves given the current sales level, the market capitalization is not excessively high, leaving room for the price-earnings ratio to increase in the future. Interpretation is possible in this way. Let's get back to the main topic. Then, let's lean in and see how the price-to-sales ratio focused campaign is viewing the current market prospects and what they are aiming for. The campaign, a major investor, said on Monday that Trump's tax policy would fail, and therefore there is a possibility that the stock market will recover from now on, conveying a positive and hopeful message. What Trump announced on Wednesday is foolish and wrong, and it's extreme, outrageous, and an absurd tariff policy. He's dealing with a non-issue using the wrong tool. What does it mean to deal with a non-issue? In fact, the current economic situation in the United States is the best in the world. Whether it's Europe or another country in Asia, the United States has been achieving substantial economic growth compared to them. Even when there's no problem, Trump takes various measures to solve this problem. That's what he's criticizing now. However, in my view, this policy will soon disappear and fail, and I think the fear is greater than the actual problem. In conclusion, it's stereotypical from now on. Campbell founded the investment firm Pension Investment. What about Trump's policy of imposing a basic 10% tariff on all imports and higher tariffs on certain countries? They said the chances of success are low because it will face challenges in the court and in the assembly. What this is about will be explained a bit later. And also, the agency is indicating that it does not have the ability to control this. He claims that most of the work cannot actually be done for various reasons. First of all, the United States agency does not have the ability to handle it. They are currently making calculations too complex and adjusting the tax to eliminate the deficit, but they still can't handle it. And another thing, the court's efforts will be strong. The United States court will not stand by, that's what I'm saying. Also, if the members of the Democratic Party can't quickly control Trump's taxes, with not much time left until the midterm elections, the election campaign starting this fall will be a disaster for them. So the number of people currently supporting the Democratic Party continues to decrease. Therefore, from the perspective of the Democratic Party members, it's necessary to control Trump, and thus the opposition to Trump within the party is likely to increase. It seems possible to summarize this way. The passive legal and political efforts against Trump's policies could be a reason why the stock market did not fall further during the Monday trading session. The S&P 500 index, after experiencing a brief downturn early Monday, it rebounded. As we saw earlier, it bounced back from the support line. The composite index last week fell 10% on both Monday and Friday. It was a tremendous drop. This is something that has only happened 4 times in history. The campaign pointed out that the stock market's reaction to the tax announcement could be overestimated compared to the issue of the policy itself. This means that the recent drop in stock prices could lead to a strong rally afterwards. What does this mean? Usually the economy and stock prices should move together, but currently the stock prices have fallen too much compared to the economic situation. Therefore, the stock price's reaction was due to the fear of the future, and it is possible that it will rise again as the actual situation improves. We can interpret it this way. The fear can exceed the real issue. Stock market comparisons over a single period are uncertain, but after the 1998 adjustment, profits rose 26% in the following period, and it could happen again. Even in 1998, the anxiety about the race has grown tremendously and the stock price has dropped a lot, but after that, the market has calmed down and raised the annual profit rate by 26%, pointing out such a historical fact. The campaign. In the recent monthly report, due to the market shock caused by the tax, money managers were thrown into confusion over the weekend. One of the investors who criticized the president, there's also another candidate, Bill Ackman, a billionaire and a novice. Bill Ackman also spoke this weekend. Due to the implementation of fiscal policy, the United States is entering an economic crisis. Trump is losing the trust of corporate leaders, he said. Therefore, from Trump's perspective, any change in approach must be taken to regain trust once again. That's what he's saying. The campaign has a history of supporting compromised election funds. He also once said that a certain amount in the stock market cannot necessarily be lower than another amount. Therefore, as an investor with the ability to view the market from a very objective perspective, I personally think we need to value the opinion of the campaign. Well, this time we just took a look at the investment return rate of the campaign for reference. I looked at the return rate of the top 20 investments that the campaign has been investing in for 3 years, and it increased by an average of 8.51%, and the return rate of the top 50 was also similar at 8.35%. Well, now let's take a look at the top holdings, the top 15 types that the campaign is currently investing in. The stock with the highest weight is Apple, with 5.91% of the total investment funds invested in Apple. The second largest is Nvidia, with 5.25%. The third is Microsoft. The fourth is Amazon. The fifth is Google. And the sixth is TSMC. The seventh is Broadcom, followed by Walmart, JP Morgan, and the 12th is Salesforce. At the bottom, you can see Meta as the 13th. As you can see, the campaign focuses on growth and is led by an expert who primarily invests in tech stocks. This way, we were able to examine his tendencies. In the current market atmosphere, there's a need to lean a little towards conservative news because overly aggressive content can be overwhelming. In that sense, we will try to introduce only somewhat positive news to you all on American broadcasts. The title of the article we will read together this time is, If the Market is Too Hard, Look at this chart. Well, let's see which chart will help to calm our minds. After President Trump announced that he would impose a basic tariff of 10% on all Chinese partners, and that the United States would record the country as a currency manipulator and would impose a maximum tariff of 50% on the country, the S&P 500 plummeted on Thursday and Friday. And on Monday, right after the opening, as the panic continued, the index fell another 4% in the early stages. It even approached the bear market territory, defined as a 20% drop from recent highs. We're discussing that well-known bear market. So even by the S&P 500 standards, it almost fell into the bear market territory, as you can see. In the early afternoon on Monday, the S&P 500 index was down about 19% from its February high. And now we are seeing a rebound of success. Investors are worried that the situation could get worse. China and other nations are already implementing protective tariffs. This could be interpreted as a sign that President Trump's tactics could trigger a trade war that could greatly disrupt the global economy. There is an ongoing concern in the United States that inflation could restart due to the widespread tariffs and that American consumers could be at risk. The overall situation is extremely grim, and we must acknowledge this. Moreover, market experts are predicting that the level of United States tariffs could exceed the Smoot-Hawley Tariff Act of 1930, which is often cited by economists as a cause of the Great Depression. In the worst case, we could fall into another Great Depression, which is why we are making this dire prediction now. When the time of economic turmoil comes, it can be felt like a nightmare. However, it is said that we need to pause for a moment and look at the situation objectively. I'm introducing a chart here, and this chart shows the historical growth of the United States stock market. After 1928, so almost 100 years, it includes the 5 most severe bear markets since 1928. And it also includes the period of the Great Depression, when the stock market collapsed by 83% as introduced here. This graph shows the 5 largest bear markets in the history of the S&P 500. Here, 1, 2, 3, 4, 5 stages are indicated. But there's one particularly interesting part. Among these, the most significant drop in stock prices was from 1930 to 1932, when the stock price fell by as much as 83%. But that was here. The problem is it's not very visible, and even after that, there was a 54% drop from 1937 to 1938, but that's not reflected either. And if you look here, there's almost no representation of the 48.2% drop from 1973 to 74. Recently, it's starting to show a bit. This part is the dot-com bubble. It fell by up to 49.1% according to the S&P 500 index. Once again, from 2007 to 2008, the well-known global economic crisis occurs, with a 56.8% plunge. Yes, and then there was Corona and the 2022 bear market, but what's important is that even after going through such a tremendously steep bear market, as you can see now, the United States stock market has risen from a very low level to over 6,000, which is extremely high. This part is impressive to us. The further back we go, the less severe the recession seems. The Great Depression is hardly even recorded. The historical rise of the stock market is a temporary phenomenon that minimizes the biggest economic disaster in American history. So there's something that the history of the market tells us. If you have the resources to invest continuously on a regular basis, such periods of downturn are often the best times to buy, reminding us once again. Everyone wants to enter at the right time, but that entry point is when the intrinsic value has dropped by 20%, says Scott Helfstein, the global investment strategist at Global X. That's when you can buy assets at a discounted price. So now is the time to keep buying. That's what he's saying. Helfstein and other investment experts acknowledge that it's not easy to buy when the market is crashing. Seriously, it's a very difficult thing for people to do. Why? Because they've already experienced losses. Right now, we already hold stocks, right? So we talk about these precious stocks that we own while looking at them. Well, I'm looking at a big loss right now, and I wonder if there's a reason to take on more risk to make this loss bigger. It's a bit of a question, isn't it? Historically, the answer is this: the market always rebounds and records new highs. So the reason we need to buy stocks now is that historically the market has always rebounded and recorded new highs, and we can find that answer by believing in this historical trend and buying stocks now. And one important fact is that, contrary to what you might think, there is a tendency for such rebounds to occur much faster. Once again, a negative historical statistic is introduced. From December 1945, after the end of World War II, to now, the S&P 500 index has a downside range of 10% to 199%. We call this a correction, and so far there have been as many as 24 corrections, and the average drop in such corrections was 14%, and it took an average of only 4 months for the S&P 500 index to recover from its lowest point to its highest point. So if yesterday was the bottom, from now on, in about 4 months, we are already recovering the previous peak. Of course, we must consider the possibility that yesterday may not be the bottom. And during this period, 14 recessions occurred, which is quite frequent, with 14 recessions occurring in just 80 years. Well, in the case of such a bear market, it usually takes about 13 months to fall from the highest point to the lowest point, meaning it takes about a year to fall. It's quite a long time. And then it starts to turn around. On average, a new high was recorded in just 23 months. Therefore, in the case of a bear market that does not fall more than 20%, it tends to recover the peak in about 4 months, but in a severe bear market, it tends to take a very long time. Why? Because a bear market usually occurs when interest rates rise or a recession comes, and because it is usually a bear market due to such economic shocks, the economy must recover in order to hit a high point again. This is what we can speculate. Anyway, when looking at the average in the past, investors may experience a high point for several years. If this adjustment triggers a bear market, so be it. And for those who rely on stock investments to achieve their goals, such as buying a home or securing a substantial retirement fund, this is certainly bad news. It could be a very difficult period for about 2 years, or even up to 3 years. However, for many investors, long-term goals like retirement can take hundreds of years. If you're in your 40s, you'll have to continue investing for about 20 or 30 years, and I'm in my early 50s now, and I also plan to continue investing 20 years. So how many years of recession are there during this period? It can appear relatively small like a potato, and it may not be clearly visible to the eye. Even during uncertain times, consistently buying stocks can lower your investment cost and potentially increase long-term profits. That's the right perspective to have. Investment experts say, to the uninitiated, the worst market they've experienced so far may seem like a short-term downturn, as shown in the graph above. So, right now, it may feel really bleak and like the stock price has dropped a lot, but if we look at the current situation in 10 years, 20 years later, we won't remember why the stock price dropped like this. It will seem like a very small blip. I'm giving you some very realistic investment advice. So, in conclusion, the expert named Helpstar advises that if you have a long-term perspective, you should consider such situations as buying opportunities. I will conclude today's broadcast with today's United States stock footage. The United States stock footage we will look at together is, in fact, the stock market forecast of Jim Cramer. It would be good to take a look at this extended footage to see what kind of expectations Jim Cramer, the host of Consumer News and Business Channel News, has for the future of the United States stock market. I would like to express my gratitude to everyone who has been with us until the end of today's broadcast. As the atmosphere may not be good, I hope you all maintain a positive mindset, take care of your mental health, and avoid stress. I will be back tomorrow with more hopeful news. I look forward to seeing you all again. We will all fight together until the day we all withdraw our investments in United States stocks. Have a happy day. Thank you.
The game planner is on the phone to plan this week's game. Jim, thank you for taking the time on Sunday night. It's a tough situation.
It's definitely too much. However, we must remember that there have been 6 such crises over the past 40 years, excluding the 6 years it took between 2007 and 2009. There were major market downturns, and each time you had to buy very quickly at good prices. Between the 2 scenarios, I prefer the first one. I don't think I should panic and sell now. It's important to maintain the current state.
You wrote an article about this in the Investors Club newsletter, and I intend to read Cramer's article to Cramer himself. You mentioned that it's logical to expect a return of 18 times on $220, and if so, the market could fall to about 4,000. However, you also acknowledged that there could be scenarios worse than that. Could there be other scenarios?
My main concern is for those going to the beach tomorrow. I don't want to cause alarm yet. The real danger is that Europe can respond, but historically, it's about every 3 to 7 years. Tends to have such an event after that period. That would be the moment to prepare if you want to start the auction right away. If you need money within the next year, you should consider selling. And if there's a margin, there may be no value to keep when considering the risk. However, in the end, I believe the market will stabilize. The president wants this tax, and there is no room for negotiation. Many parts are being affected by Peter Navarro. Peter wants a global trade war with China, and it really seems like he wants all countries that send us goods, including China, to impose high tariffs, which is not a good thing. So we need to solve that problem. The market will adjust itself. If you're looking for a cost-effective center, it's the United States. It has not been directly affected by taxes or related pressures, and this sector is strong because of its low interest rates. Interest rates are falling, and I thought it was a good sign that the central bank officials said today that both rates and oil prices are falling. However, the problem is that the dividend yield also needs to decrease, and this affects the amount we are willing to invest in stocks. And this is exactly the multiple contraction we are seeing right now. If earnings announcements begin within the next 10 days, profits are likely to decrease.
Yes, it's certainly important. It's not just about the numbers. The company argues that what the company says is important because most of the day's earnings, or at least the tax announcement, occurred before the tax announcement. So what are you paying the most attention to right now? What are the 1, 2, 3 on Jim Cramer's watch list?
First, I would focus on the interest rate. For example, if the yield on a 10-year Treasury note falls to 3.5%, the mortgage rate will also go down. This could have a positive effect, making people think it would be good to buy American companies, right? What's most important to me are American companies that are not exposed to taxes, but they currently look attractive. Even if there is a surplus or it becomes burdensome, I don't want to be affected to this extent, so I want to look at such companies. Secondly, it's a matter of whether there is a person who is disappointed. If you see the main movement, the problem is whether to say that we will focus on American companies that are not affected by the tax and non-American companies that are affected by the tax. It is important to transition to business in the translation. The business department will come out for a moment. Despite many companies moving to Vietnam, they are still importing Chinese products and are competing with companies in Vietnam that are shipping Chinese products. I should say, the business community should focus more on the impact of the tariffs implemented during the trade war, particularly those received by President Peter Navarro. I want to make a few suggestions to help American companies do better, not to eliminate competition. After that, I want to see how far the situation will stabilize. Again, I want to emphasize that tomorrow may not be the bottom because Europe has not yet recovered. I am looking at the S&P 4000.
Wow, the S&P has come a long way.
We're heading into October 2023. What I strongly want to emphasize is that we need to maintain the course. Even when the market plummeted by 46% back in 2007, it was logical to maintain the existing strategy. It really was a steep drop. However, by 2013, it had returned to normal levels. Think about the gains you would have missed if you had pulled out. So take it calmly and acknowledge that there would be some discomfort. It's unavoidable. If you need money next year, it's not too late to sell now. However, I'm seeking opportunities from market volatility. You will see a large amount of capital continue to flow from large foreign companies without tax issues to companies that do not have them. The race will likely tighten, as many will suggest, even without my input. There is a level where I can be fully absorbed, but it won't happen if you fall into the panel.